These guys, they floated BDCs, business development companies. Some of them private, still no problem. You're only raising money from qualified investors, from high net worth individuals, people who can afford to lose money, no problem. But they also listed one of their BDCs, Blue Owl. Imagine that there is a listed entity in the US which you can put money in as a retail investor, which you can put $100 in, and they're going to take that money and lend it God knows where and doing God knows what. I mean, they have their standard disclosures, but how much leverage is there in the system? How many times over has the same asset been pledged and the same cash flows being used to pledge another asset, etc., etc., etc.? How far does the rabbit hole go? You don't know.
Welcome back to Hype Cycles, where Nitesh and I, Vineet, we discuss what's been trending, what's been happening in the tech and the business world, and a lot of the AI world. But this week, nothing's been happening. Nothing has been going on geopolitically. Nothing at all. Nitesh, nothing's been going on, right? Please answer affirmatively.
Yes, I don't know Morse code, or I would have blinked it out for you. No, nothing's going on.
Nothing's
Nothing.
going on.
Yeah.
Nothing's going on. That should be the new name of our show. Nothing's going on. Because sometimes we wish that nothing would go on. Life would be peaceful. Nitesh, what's been? I can't even say what's been going on. There's too much that's been going on. It's
No,
like a
no.
3-hour podcast in itself.
Gently trip the current events via. Oh, I get that. No, I have something nice because we had some real nice banter before we started. Have you seen We're the Millers?
No, I haven't, but I've heard about it. Tell me more.
It's like Ted Lasso, but edgy, but wholesome, really funny. The movie itself is awesome. There are outtakes of the movie, just a small, like 2-3 minute clip on YouTube. Look it up. You need to have watched the movie. Why it's so funny, but so good. So,
I
so
will
good.
do that. I will add that to my list. We are the Millers.
Yeah, We're the Millers, really funny. On outtakes, I just suddenly had this memory of all Jackie Chan movies. Those are the only ones where you would sit for the credits because they would have the bloopers. Those are, I miss that, man.
I miss the DVD outtakes. I am going to, so I'm probably shifting in a couple of months. I am going to build a DVD and CD library again. I am going to go old school and not so old school to go vinyl.
Right.
I'm thinking CDs are great.
Right.
CDs work. CDs get the job done pretty well. Uh, but yeah, like we lost something when we moved to streaming, right? Nobody's recording that level of BTS anymore, which is sad.
Hmm. Or
Lord of
even
the
at
Rings
this,
is the ultimate collection of BTS, right? That people are still discovering and oh, I just learned something new about these movies today. So
yeah. Uh, I think we peaked with the Lord of the Rings movies as a civilization.
as a civilization,
I think
as
we peaked.
society, as
It's been
humans,
all downhill from there.
pretty much. Let's just get into our story this week, which is about Nitesh. Lead.
Yeah. Okay. Up top, this is a really dense topic, and almost everything I say has an exception because of how complex the ecosystem is. Okay. So I'm oversimplifying. I know I'm making a lot of sweeping generalizations. It's the best I can do, right, to keep this conversation accessible. There's this small 3 minute scene in It's a Wonderful Life, which is a great black and white movie. You should definitely watch it. It's about a run on a bank. Essentially, any bank, even the banks that your money probably is in now, beneath yours, mine, everybody's, they
I'm
operate
having a
on.
chill Sunday, man. Don't make me panic. I'm having a chill Sunday.
You think I'm going to start a bank run here just by speculating and naming a small bank? That's all it takes, by the way, which is the point of the scene in the movie. But anyways, all these banks, first of all, the money that you've deposited with them and the money that millions of people have deposited with them isn't lying there in the bank. I mean, of course, it's all digital now, so there is nothing there. It's just a bunch of numbers on ledgers. But even when you were actually depositing and withdrawing cash, not all the money you gave to the bank kept itself, right? How would it make money then? It loans it out. And all banks have this structural dichotomy in which, with a savings account, let's say I deposited 10,000 rupees in my unnamed bank account. Not Benami, I mean, I'm not naming the bank. that money, I can withdraw it anytime I want, right? I mean, the bank branch doesn't even need to be open. I can just transfer it out or go to an ATM and draw the cash. The bank doesn't have that money. It took my 10,000 the day I deposited it and presumably made a loan with it, right? An auto loan, a home loan, whatever. Like It's a Wonderful Life. Let's say they are all home loans. Home loans are usually 15 years, 20 years, 30 years, even nowadays. So the bank has what is called a duration mismatch. It's really simple. I can ask the bank for my money back at any time, but the bank cannot tell the people it had loaned money to. If Vineet has taken a home loan, for example, my 10,000 rupees went to the bank and Vineet bought this amazing home for the same 10,000 rupees. He's borrowed it from the bank on a 30-year loan. I can ask the bank for my money back at any time. The bank can't ask Vineet to prepay that Nitesh needs his money back. Please give it back. That's not how it works. This is a structural problem because at any time, if me and a lot of people like me suddenly, for whatever reason, a rumor, uh, war, whatever, or just illogical panic, if we all decide to go to the bank and withdraw our money, the bank, any bank, cannot repay it. Right? I'm not even going to introduce the concept of fractional banking, in which banks can make larger loans than the money they have. But even setting that aside, just even if a bank is maintaining a 1-to-1 ratio, they cannot repay all of us at once, even though that is our right. Right? So this is a big problem, and it's a problem that all banks face all around the world. Any bank that is accepting public deposits has a duration mismatch. There are safeguards, workarounds. Like here in India, we have an insurance, right, up to 5 lakhs, I think it is now. And your money in any bank up to 5 lakhs is guaranteed by the Reserve Bank of India. So even if your bank shuts, if there's a run on the bank, they aren't able to pay everybody. A run is basically everybody trying to get out the door at the same time, which is what the It's a Wonderful Life scene shows quite beautifully. And the RBI says if that happens, up to 5 lakh rupees per depositor, we will repay you. So you don't need to panic. And this is standard practice. Like even in the US and most countries, the central bank guarantees deposits up to a certain amount that are made in your retail banks. All right. But this does not completely, this assures depositors that you don't have the money, you don't have to worry. Sooner or later, you're going to get your money back. But the fundamental flaw is still there in the banks, the way the banks' cash flows are structured. That money can go out at any time, but it only comes in over a long period of time. Really simply, that's the problem. Because of, I mean, how far back do you want to go? Uh, After the depression, the US brought in regulation.
2000 BC.
No, let's stay in post Dark Ages, right?
Yeah,
Let's re- maintain the scope of our discussion to around that time.
you're boring.
Any financial discussion that I start, the farthest back I could go reliably is the Great Depression, right?
That's fair.
Because because my education begins when Warren Buffett was born. Like that's the moment my timeline starts. Because everything after that has been documented so nicely. And before that, it's there, but okay. Let's not digress too much. Post the Great Depression, the U.S. introduced legislation says banks who are taking deposits from the public cannot speculate with that money. You can make reasonable loans. You cannot speculate with that money. You cannot do derivative trades with depositors' money. Sensible, and like you have to understand trust in the banking system after the Great Depression, after 29 crash and up to 33, 34 was completely gone. People did not trust banks, and banks work on trust.
Hmm.
Right? All the mechanisms that you have in place, the big locker that is there even today in your bank branch for show, is so you trust them. because without trust, banking doesn't work. Modern banking doesn't work without trust. They said we'll separate both functions. If you want to be an investment bank, you want to do prop trading with your own money, you can do that. You want to take public deposits, you cannot go to the casino with that money.
Yeah, people should know that their money is being used for hedging or investment or
No, it isn't
basically
even
trade.
a
Right.
disclosure. The post 1933, the legislation was you cannot do this. You cannot do this. You're supposed to take deposits and make sensible loans, uh, which will mostly be repaid. That was the premise. This continued. The US financial system and the global financial system got more and more complex. I think it was Clinton who repealed the law that was
Glass-Steagall. Yeah.
yeah, Glass-Steagall was repealed. Then look at Vineet, the financial geekery. Nice. Clinton repealed Glass-Steagall, and it can be argued that that's what precipitated the GFC of 2008. There are arguments for and against, but I'm kind of in the for camp that yes, at least in part, it was triggered by that because things just got looser,
They got
standards.
murky. They got very murky and more complex. See, those complex mechanisms that did not exist and could not have been accounted for when the law was created might still have happened. But yeah, this sort of just lubricated the process, so to speak.
Right. Uh, Catalyzed it, sped it up, lubricated, say what you want. So again, like the Glass-Steagall Act was brought in as a response to the Great Depression after 2008, when the TARP Act happened and all these financial institutions were bailed out by the US government. They said we're going to bring in something called the Dodd-Frank Act. Dodd-Frank, again, was kind of similar in spirit. They said separate these two activities. It is not healthy or advisable for a deposit taking bank to speculate with that money. You're going to have a problem. So, for all the loans that a bank is giving out from the money that it is taken from depositors, we're going to have a hierarchy of risk. So, at the top, if you're buying US treasuries, then you can make a one-to-one provision for it. Like, this is my equity in the bank, and uska equivalent, I can make out loans. So, that was 100% provisioning that you needed to do for US treasuries. Going up to for really speculative stuff, like if you were lending money to a startup or whatever, just as an example, you would have to do a lot more provisioning of your core equity capital. But essentially, the new norms made it not impossible, but bothersome for banks to lend to unrated private players who could not go through the bond route. So that if you're a startup or if you're a company, your one of the ways you can raise money is by selling equity in your company, selling more shares. The second thing you can do is issue bonds. So you have a particular bond with a particular maturity, a coupon, and you take that money and you build a factory. These are the two public market options, let's say. The third is you can go to a bank and say, give me a loan, I want to build a factory, right? Now that part of it in the US, that loan, it was not so lucrative and actually kind of restricting for banks to make that kind of loans because it affected the rest of their balance sheet because of the new norms that had come in post 2008 to prevent another financial crisis. Are you with me so far? Okay. This created a gap because not all companies want to dilute equity every time they want to expand. Not all companies want to be in the bond market. Some of them maybe are not worthy of a very good credit rating, so they would end up paying like really high rates of interest. Some of them, there's just no interest in the paper. Nobody knows who they are. Like if it's a small um, castings firm in Rust Bucket, US, they cannot go to Wall Street and say, I want to issue bonds for like $5 million. it does not make sense. All these years, that gap was filled by the bank, by their local bank, in fact. But increasingly, even the bank was, it had been consolidated into a bigger bank, and bigger banks were not interested in this business. It was not lucrative, it was not fun. So that created a gap, which is where private credit steps in. And that's the protagonist of our antagonist. We'll see. That's the focal point of our discussion today, which is private credit. That's how it came to be. Businesses will need money to grow, to acquire other businesses, whatever. And because banks are no longer happy to take that role, private credit firms stepped into the gap. This was part of, again, just one last bit of context before we get into the meat of the discussion. Venture capital, venture debt, private equity, and private debt, all these things, these four categories, became really, really popular because of the Yale endowment.
Hmm.
Before that, any college endowments or pension plans, they were following the 60-40 model. 60% अपना पैसा stocks में, 40% bonds में. Uh, these guys were managing billions of dollars, but it was considered the most boring corner of finance because they were so restricted in what they could do. The Yale endowment did something path breaking, right? It's called the Yale model because they were the ones who pioneered it. They said, because we have no immediate liquidity needs, like we know how much money we need every year, how much we owe to the university for its day-to-day functioning. The rest of it, we don't mind locking it up for longer and longer periods if we can get a little higher return, right? That was the genesis of venture capital and venture debt and private equity and all of that. All that money started flowing to these guys because the endowments, the pension plans, they realize that they have a lot longer time horizon than the market provided. Like equities, they could exit the next day, and that liquidity costs a little bit of return. If you run a startup, Puneet, if somebody were to invest in a startup, they would require a longer time commitment. Like if I'm buying stock of a company tomorrow, I can exit day after tomorrow, right? In the public market, I don't have to even think about it. Like it's such a well-oiled mechanism. But with private equity investing or venture investing, it can take a lot longer for the investment to either bear fruit or give me a secondary exit opportunity, whatever. I'm essentially foregoing liquidity to get slightly higher returns. Yale pioneered that at the institutional level, and that caused like trillions of dollars to flow into these new asset classes, which were not popular, which almost did not exist before. Again, one last bit of context. Before private credit, there was the junk bond market. It still exists, but it's a lot smaller now than it was before. Companies which could not raise money anywhere else, which even a bank would not touch with a 10-foot pole, could still issue bonds at like 16, 17, 18% interest rate. These were junk bonds, very high probability of default. But if you could pick them well, you could make a lot of money because you're getting like 18% and your money back, which is great, which is what Milkinson did. But anyways, again, a whole separate conversation. With all that context, these are the structural reasons why private credit exists, why so much money has flowed to it in like the past 10 years, 15 years. And yeah, are you still with me?
That was a lot of heavy context, but yes.
Sorry, it's Sunday and you've unleashed me on a deep, really geeky corner of finance. So I love this shit.
Yes. But I've understood now private credit, why it exists and sort of where it is. And yeah, mostly why it exists.
Right. So again, back to the place where we started the conversation, which is a bank has a duration issue. Private credit is awesome. They solve that problem, right? They can make really long loans. It doesn't matter because the guys who have put money in there also have really long time horizons. The insurance companies, the endowments, the pension plans, they don't need their money back for 30, 40, 50 years, right? It's almost perpetual capital, which is the dream in finance. If you can get yourself to be the manager of perpetual capital, you hit the jackpot because you can get a management fee on that forever. Like you can take 2% of the top every year if it is perpetual, right? Bill Ackman tried that, it didn't quite work, but that's the dream. If you can match duration, you can make a lot of money that way. So the premise of private credit firms was we will find borrowers who need money for a long period of time. We will raise money from pools of capital which have a really long time horizon as well. And so we will never face a run. The the problem that happens in It's a Wonderful Life of everybody asking their money back for once, right? Because you're sitting on such vast pools of capital and they're just allocating a small part of it to us. So even if they need money, they will liquidate their other maybe public holdings or whatever before they come to us, right? That's the premise. And it makes sense logically, intellectually, it makes sense, which is why so much money flowed to it. The problem with private anything is that it's opaque, right? You don't know who these guys are lending money to. You don't know what kind of due diligence they've done. You don't know what their duration is, what the average tenure is of the loans that they are making, how the cash flows are coming in, are there defaults happening? Their principals know, the people who have given them money know, but we don't know, right? It's a black box for us, which means when so many trillions of dollars are flowing through this pipeline, there may be leverage in the system that we are not aware of, right? Because like all lenders, Blue Owl and all of them, right? They will still do their due diligence. They're still going to ask for collateral, like a traditional lender would. Okay, you want to, just as an example, and I'm not just pulling this out of my ass. You want to build a data center? Great. What business are you in? Oh, you already run data centers. Great. Oh, you were a crypto miner earlier. Great. You want to guess which company this is?
Which company is doing the lending?
No, the borrower, which used to do crypto mining earlier, moved into data centers.
CoreWeave?
Yes. Blue Owl has done a lot of business with Corby.
By the way,
And
on this note, their biggest partner I found out, which is this company uh, 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 called Applied Digital,
right.
right? Which is one level deeper in doing the construction, a lot of the support for these data centers.
Mm-hmm.
They had changed their name in late 2022 to Applied Digital officially. Do you want to take a guess what their earlier name was?
No
Hint,
clue.
Applied was still there. Digital used to be blockchain. It was Applied
Yeah.
Blockchain,
So
became Applied Digital.
a lot of the grifters have moved from crypto to AI.
Now, unrelated note, Nvidia moved from crypto to
It was
AI.
Stan Jensen wrong too. I'm not saying anything.
I did say unrelated note, don't sue me.
Yeah, we're not going to discuss Nvidia earnings. Let's not get derailed. So CoreWeave came to Blue Owl. Blue Owl is the poster child of private credit that we are going to be talking about today. We could go into their history, and I think we'll have to sooner or later. But anyways, CoreWeave came to Blue Owl and said, we want to build data centers. We want to buy a lot of chips from Nvidia. So we need credit. Blue Owl said, great. What business are you in? He said, yeah, we used to be crypto guys and crypto miners, and now we have data centers. I said, okay. So what collateral can you give us? I said, we have assets, right? We have the data centers. We have the GPUs in the data centers, which are like worth their weight in gold. That's just an expression. Please don't take that literally. They said, okay, so here's the collateral. We have a first claim on that, senior secondary claim on that. And here you go. Here's some money. Go pay NVIDIA and set up a new data center. This guy said, great. They took that money, set up a new data center. Or actually, I don't even think they went all the way through with that. I'm speculating here. This is what I could gather. They placed the orders and maybe took delivery but not yet deployed the NVIDIA chips, and then used those as collateral and raised more money from more private credit players, including, I think, Blue Owl. So that's the leverage in the system that I'm talking about. And because it's private, we have no accurate way of mapping out what happens if AI demand falls, or if they have the chips and everything is working fine, but there just isn't enough electricity to power them, right? Because everything is dependent on the cash flows. These are loans. Again, this requires a slight shift in thinking. When you're thinking venture capital, when you're thinking equity investing, let's say you're making 100 investments, right? 50 of them go bust, 50 of them, or 40 of them do all right, 5 do well. The last 5 do so well that they pay for everything.
Hmm.
That's the classic venture model. Great. If you're on the equity side, great. The thing with debt, and the reason banks are so conservative, is you don't get any of the upside. If I lend uh, 1,000 rupees to you, Vineet, and a year from now you are an AI billionaire, you're still going to pay me back only my 1,000 rupees with interest, right? I'm not going to participate in your billionaire journey except for my 1,000 rupees. So I don't care how successful you get. I just don't want you to go bust. I want my 1,000 rupees back. That is all I care about, right? In this scenario, if Blue Owl or a private credit lender has made 100 of these loans, and even like 15 of them default, it's going to be a problem because the other 85 cannot make up for it, because all they're going to earn back is the principal and the interest. There is no upside above that. It's capped. So it's really, really bad for there to be leverage in this system, because Blue Owl does not benefit from that leverage.
Yeah, so the risk is absolutely much, much, much higher than the reward.
There is no reward.
There is no reward. The reward is that
They
180
money
rupees on
back.
your 1,000 rupees
That's
at
it.
max.
That's it.
Yeah.
That's the most
And the
they can
risk is 1,000 going to zero.
exactly, which is catastrophic because it causes a cascading failure, right? Now all this happened, okay. But still things are chugging along, and vast AI infrastructure is being built on the back of debt, no problem. Software companies found that they can, just SaaS companies can borrow against future cash flows. Simple, right? But then the SaaSpocalypse happens, and suddenly those future cash flows that are there in all the Excel models that all these guys are using, they don't work anymore. What if the 10th year earnings are half of what they are projected to be? What happens then? You can't issue a margin call to a SaaS company. They don't have any assets that they can pledge with you, right? The whole loan was made against future cash flows. And if those are called into question, then what happens, right? But there's still one more small piece of this puzzle. If they're still just working on Yale money, on pension funds, no problem. थोड़ा पैसा अटक गया है, we'll give you your money back. वैसे भी we have made commitments for 20 years, 30 years, तब तक things will level out, or we'll see, you know. But private credit was so capital hungry that they crossed the threshold. They raised retail money also. So they have these special purpose vehicles, business development companies. Basically, Blue Owl floated a new vehicle, I want to call it. Yeah, they floated a new vehicle. They said, we're going to take in these guys. They floated BDCs, business development companies. Some of them private, still no problem. You're only raising money from qualified investors, from high net worth individuals, people who can afford to lose money, no problem. But they also listed one of their BDCs, Blue Owl. Imagine that there is a listed entity in the US which you can put money in as a retail investor, which you can put $100 in, and they're going to take that money and lend it God knows where and doing God knows what. I mean, they have their standard disclosures, but how much leverage is there in the system? How many times over has the same asset been pledged and the same cash flows being used to pledge another asset, etc., etc., etc.? How far does the rabbit hole go? You don't know. But these are public vehicles, you can invest in them. But then that was the whole premise of private credit, right? That you did not want redemptions at will. That was where we started. Okay, nobody can turn up at your counter and say, "Give me, I want to make a withdrawal." That was what private credit was supposed to avoid. But because their need for capital was so much, and because it's the dream of any financial engineering firm, that's what these guys are, right? It is the dream to finally be able to take dumb money, which is a retail investor. They said the right incantations, they managed to crack that. They got public money. They said we have a solution to the liquidity problem also. Okay, if you're taking public money, what if people want their money back? We'll put a system in place. Every quarter, 5% redemptions are allowed. अगर अपना fund $100 million का है, every quarter, 5 million worth of redemptions can be made. We will provision for that every quarter. We'll plan our cash flows in such a way that every quarter, 5 million can be redeemed. Can be redeemed. Correct? फिर भी ठीक है. Retail investors were happy. Liquid भी है investment, plus we are getting the additional return of a private instrument. Best of both worlds. Great, right? But then the SaaSpocalypse happened, and Blue Owl the OBDC II, the listed vehicle that they had. It turns out they had about, I want to say 15, slightly less than 15% of their loans were to SaaS companies against future cash flows. Retail investors panicked because SaaSpocalypse, everything is going to die, right? All software companies. And I have exposure here. Let me draw my money. There was a run on OBDC II, which is a listed entity, which is exactly what they set out to avoid. The irony. These guys knew they cannot meet all redemption requests at once. It's not possible. So they gated the fund.
What does that mean? Gated the fund. It sounds nefarious. No good can come from this term.
They blocked withdrawals, blocked redemptions.
Blocking redemptions is so much simpler, but no, we have to call it fund gating. Oh God.
That's,
Yeah, ouch.
that's a legal term. Now, if you're an institutional investor and you have invested money in 100 or 50 venture funds of various vintages with various fund houses, you have your some money is in Sequoia, some money somewhere else, whatever. One fund manager says, I'm going to get my fund. You are the California Teachers Pension Fund, right? You can strong arm the fund manager. You are not getting the fund. I want my money back and I want first dibs. Liquidate whatever you need to liquidate. Give me my money back. You can twist their arm. But यहाँ पे retail investors, there's nothing they can do, right? They said, we want our money back. This guy said, no, we are getting the fund. Because these are illiquid investments. We cannot sell them at will without taking a massive haircut. Right? They can sell the loans. The US financial system is sophisticated enough that they could sell the loans in a week. But it would be at a big haircut. They didn't want to do that because it would affect all the other things that they're doing. This is just one fund, right? If they admit defeat or even accept a shadow of weakness, it's going to cascade wherever the Blue Owl name is. And trigger a series of redemptions in the other vehicles also, which they did not want. They said, okay, we are getting redemptions. What we are going to do is, whether you asked for it or not, 30% of all the funds we are going to give back. Just
Sorry,
if
we're
you
going to do what?
if you had invested $100 in OBDC II, you Vineet, you're going to get back $30, whether you want it or not, whether you asked for 100 or 5 or 0, whatever. Everybody who has money in the fund is going to get back $30. We're going to do a 30% voluntary disbursement. How are we going to do this? We are going to sell some of our loans to people who are willing to buy them. All right. We're going to sell them at 99.3. Don't quote me on that. 99.3 cents on the dollar. So no haircut.
Hmm.
Now, interesting. Who's buying then? If you're selling and you're able to sell at such great values, who's buying? Two of the companies who are buying are other investment funds. Fair enough. The third is an insurance company that blew our controls. Again, insurance companies have long tenure appetite. So they've moved these loans onto the insurance company's books, one third of them. The other two thirds have gone out. Could be argued that all the transactions were done at arm's length because we are not just moving money within our funds, right? There are outside investors involved and they're not going to pay more than the loans are worth. So Blue Owl points to that and says, look, we are getting 99.3 or 4, I think, cents on the dollar. Our loans are good. Here's your money. You have liquidity, go away. Right? Still, OBDC II, as of today, is trading at a vast discount to its NAV, to its net asset value. Because the market perception is that Blue Owl has sold the best loans. What's left is crap, which if they try to sell, they're going to take a haircut. Nobody wants to be left holding the bag. And that's why the OBDC's stock price is tanking. Ticker price is tanking. And because of that, Blue Owl itself, its stock price is also tanking. Because everybody wants out. But because it's private and there's a liquidity, you can't get out. Yeah, I'm all talked out. That's what happened. And there's like trillions of dollars of such money sloshing around in the system. IOUs built on IOUs, built on IOUs. And the market is genuinely worried of what if the whole thing collapses on itself. That's where we are in a nutshell. Yeah.
But the positive side is that Sam Altman is a very reliable man. He will save us all and he will sell $300 trillion worth of AI services in the next 3 days. Right?
I don't know, man. I don't know. It's such a cheap shot.
At Sam Altman, he deserves all the cheap shots. What? What? You're saying I took a cheap shot at Sam Altman?
No, I guess I'm disappointed that that's all the response I could elicit after a what 50-minute rant.
Well, 35 to 38, I think. We had 2 misfires. But yeah. No, it is just, there is, the problem is that there is nothing at the end of this to, the value is just not there to save this. There is a lot of trouble and there is a lot of companies going back and forth creating these investment instruments just to disguise the fact that they want in. And yes, the silly part in my completely untrained mind is that at least the companies doing the AI stuff, they are chasing this crazy upside.
Right.
What if all we are pitching already comes to be true?
Mm-hmm.
So they get this fantastic upside.
Correct.
Like as you pointed out, the lenders don't even get that. So what are they taking these insane risks for, and on the basis of what is my question? Like, okay, you could say there is a 5% chance or 2% chance that this becomes wildly successful.
Mm-hmm.
They don't, like you pointed out, they don't see that upside. They are banking on the fact that it has to happen so we get our 15 to
Money.
18%
Yeah.
money. So in a way, these guys are the most optimistic about the AI boom, practically by definition, because there is none of that 5 to 100 ratio that is happening here. In their head, this has to work. This will work. Yeah, I don't get it. And it's because of these guys that the whole data center boom is happening. Uh, I don't get it. By the way, one interesting aside here, completely, well, sort of unrelated. So, which is a point brought out by the Vergecast, which is another one of my favorite tech podcasts, last week, that the Oracle deal that Larry Ellison was bankrolling, and that has now seems to be happening. There are still regulatory approvals, hurdles to be crossed, but yeah, Oracle is a company that has no money, or rather needs to put whatever it has. It is running on negative cash flows right now, like we've discussed before.
Right.
Whatever money it has, it needs to put into data centers to be able to provide multiple gigawatts of compute to OpenAI as part of their $300-ish billion deal,
Mm-hmm.
right, over the next 5 years. Whatever money it has. In a way, Oracle has banked its future on this, right, on AI making sense that it will work.
Right.
Meanwhile, Larry Ellison is putting his private money. This is not Oracle trying to buy out Warner Brothers. This is Larry Ellison bankrolling a bid by Skydance, which is his son's company, which is worth a fraction of what they are offering to buy Warner Brothers for.
That's really,
Right.
yeah.
So the question is, you are in the center of the AI thing, right? The whole hype cycle.
Mm-hmm. Nice. Mm-hmm.
You have limited money. Well, okay, Larry Ellison is the second richest man in the world, or at least he was, right? But still, the kind of money that is being required to pump into AI, into the data centers, is
Mm-hmm.
insane. It is crazy huge. And the money they're trying to buy Warner Brothers with is also insane. And Larry Ellison seems to be favoring the Warner Brothers deal. Ki in the middle of the AI boom, I actually want to take out 70, 80, 100, $105 billion and pump it into Warner Brothers. So in effect, isn't like that's him putting his money where his mouth is. That there is this whole AI boom, and AI is supposed to save us all, and it'll add trillions to the world, whatever, all that chit chat, right? But I would rather take all my money and pump it into Warner Brothers, a traditional media company that has actually bankrupted so many companies in the past. So that is in effect, yeah, putting his money where his mouth is. That's where he sees the money coming from, rather than actually the AI boom working, which is a very interesting
Okay,
point.
that's him putting his money where his anus is. But when else are you going to do this? For Larry Ellison.
Never, never,
Exactly.
no, never.
Exactly. This, if you were inclined to do a deal like that, I- the numbers that are being thrown about that this is Larry Ellison's personal wealth with he's backstopping the deal. Where does that money come from? It's private credit.
Yeah,
It will be facilitated by his Oracle shares, right?
yes.
I don't think his personal net worth, apart from his Oracle shareholdings, is quite substantial enough to backstop.
Exactly. So even if he's worth like 300 odd billion dollars, right?
Most of that is from
Most of it is locked into Oracle stock.
which he can't sell, but
Which
he
he
can
can't.
pledge. Okay, so he's pledged them, he's used the money. That's more leverage.
Yes.
That's another hidden, just entire domino chain waiting to be triggered by even the smallest gust of wind.
I think
It's
the
right there.
smartest guy in all of this was just the 30-second milestone guy who took the shareholding of 32nd Avenue or whatever it is now and just sold it to multiple people. Maybe that's what Larry Ellison is also doing. My Oracle shares, I will pledge them for my AI data centers, and I will pledge the same shares for my uh, Paramount, for my Warner Brothers deal. Who knows? Or maybe it is. it's going to end up like Twitter, where suddenly it's going to, no, I don't want this. I don't want this. No, I never wanted this. I was just making a 420 and 69 joke on Twitter for my fans. I don't really want this. It was a meme. Ha ha ha, guys. Ha ha ha. Oh shit. One never knows.
On that aside, I think Twitter's CEO, his name escapes me at the moment, did a fantastic job of
Oh, Agarwal, right?
Parag
Yeah.
Agrawal, of
Yeah. He did exactly what he was supposed to be doing, and he did it really well.
getting Elon in the pincers
Hmm.
and just making sure he paid. Beautiful. Well
Bad for
done.
the world, though. Like, Twitter used to be an amazing place for real time news, right? And now, though there is absolutely nothing going on today, nothing, no geopolitics stuff. I go to Twitter and it is just terrible. You don't know what is fake, what is real. You don't know what is whether this checkmark account is genuine or not. Half the media has actually left. Only the right wingers are left. But yeah, but he did his job fabulously well, actually,
Yeah.
what he was hired to do.
Brilliant.
Yeah. So yeah, coming back to all of this stuff, what's happening with Blue All? Where are they today? What is their status financially? Where do they stand?
The company itself is listed. They have insurance business. They have a bunch of these BDCs, uh, some private. I think this is the only public one, but I'm not sure. And again, this is just the most visible example of the amount of leverage in the system and the problem with trying to get out all at once. There are a bunch of companies like this who are doing the exact same deals on the exact same terms. It's not going to end well.
Also, because now the demand side, right? Again, all of this, and most of it is for AI, right? Most of this private credit, like the bulk of it, for the data centers that will power this compute. What is the most popular AI product you can think of? What name has kept popping up in the last 1 month, 1.5 months? If you had to think of a product, Claude Code, right? Exactly.
Yeah.
What do you think is their ARR at this point? Claude Code, that they were proudly bragging about a month ago, a month and a half ago.
A few $1 billion.
$1 billion. 1 billion.
A billion.
One.
Despite all that noise.
Exactly. And ARR, as we know it, is just basically how much have I sold this hour or this day and multiplied by 365, right?
Yeah.
That should be highest when it's at its peak.
Hmm.
Before something else comes along. $1 billion. And then they later said, like I think about 15, 20 days ago or a month ago, that it's increased to by like some $8-9 million a month or $10 million a month.
That's it.
Yeah.
So
Anthropic's total ARR is about $9 billion.
that's really surprising because Cloud Code is only on the paid tier.
Claude Code is only on the paid tier, I think, or meaningfully at least, right?
Nay, it's not there for free at all.
नहीं है तो नहीं है, हाँ. Right. And therefore, and even if you say, okay, maybe they're apportioning it wrong, they don't know, how they're splitting it between regular Claude and whatever. The total ARR is $9 billion. Let's say it increases to 10. Let's say we round it off by $1 billion, right? And this is ARR, this is not actual revenue. And
Yeah,
let me
Cloud
verify that.
Code is only on the Pro and up plans.
Hmm.
It's not on the free tier.
Yeah, so this is verified that by the end of so they said this in November that ARR is $1 billion, and by December they said it grew by $100 million. So yeah, another $8 million a month. So that's it. That is Claude Code ARR for the most popular AI product in existence. That is crazy hyped. And nobody even talks about OpenAI anymore in terms of product. They've got Codex.
Yeah.
It is supposed to be great, similar, whatever it is. I haven't. I have fully switched over to Claude now.
Claude. Okay. I haven't logged into ChatGPT in a long time.
It's pretty much a dead account. I use it for my old threads sometimes, but barely, like no new usage, not even Gemini. But yeah, so that is at the end of this.
For
Sorry?
free. Despite the fact that we have it for free.
Gemini, yeah, I have it for
No,
free.
ChatGPT is well, right?
PT, no, so they call it the
Oh,
pro version,
they had introduced a lower price tier for India.
which then they made free for a year. I am on that.
Yeah,
But
exactly.
apparently, the GPT 5.2 on that tier,
Mm-hmm.
even though it's supposed to be the paid tier offered for free, is wildly different from the actual if you pay $20 a month for, which is again just bad product management. Because I think I'm on the paid tier, getting a paid product for free, and it turns out to be shit. I am not thinking I should pay. I am thinking I'm already on the paid tier. If you tell me, yaar, ye free mein ye hai, 5.2 reduced or 5.2 mini or whatever, pay $20 and get to proper 5.2, sure, I'll be like, okay, there is a value in upgrading. But if I'm already thinking I'm on the paid product, why would I ever pay
I agree.
if it turns out to be terrible? So, and it is absolutely terrible. Somebody did a uh, test. This is a wildly popular reel, TikTok, whatever you call it, right?
Mm-hmm.
Somebody's on voice mode on ChatGPT, paid, asking it, I need to take my car to the car wash. The car wash is 100 meters away. Should I walk or should I take the car? And GPT is like, why don't you just walk? It's just 100 meters, right? Everything is already set up there. Just walk. There's no reason to take the car.
Your
So,
explanation
so
was
that like quality of products aside, the numbers just are not there because the private credit side is a new angle to what we've been talking about anyhow, which is where is all this like the tech giants are pumping in crazy amounts of money. They're going like Google has gone cash flow like near zero. Right. So yeah, you could say that great, they haven't gone cash flow negative, but this is a company that was printing money through Google Ads,
for
right?
tech.
Which is their one big money spinner.
Yeah. All right. Let me stop you there. I think in the last month or two, my thinking has evolved on
Hmm.
this, or at least I'm able to better articulate how I feel on the subject. Yeah, I'm going to plug my own work here. I just wrote a nearly 3,000 word article on Indian textbook publishing. All right. Now, the style, structure, level of research was similar to articles I have written for different industries over the last 3 years. Okay, more or less the same. Uh, word count थोड़ा यहाँ वहाँ होता है, but depth of research is usually the same. That's the level that I'm comfortable at. And this time I used Gemini because we are all on that lovely free plan.
Free plan.
Yeah, and it's like Google on steroids, man. अब इसमें थोड़ा दुख भी होता है because one of my core competencies was Google Foop, was being able to find anything online in some obscure corner, and that skill of mine is worthless now because Gemini can find anything anywhere on any corner of the internet.
Also, Google has killed the internet, right? The free and open internet. So yeah.
Nick, but for my
Sort of.
research, I was using like Wayback Machine and defunct blogs and some PDF that was written somewhere and has somehow been archived on some university's server for some reason. I've dug really deep for my previous pieces, and now Gemini does all the digging and does in many cases a better job than I ever could of finding relevant stuff. Lots of dead links still, but that's a different problem. The internet is dying, right? Per so the point I'm trying to make is AI as a tool is here to stay. Just like internet was there to stay in 99 and in 2000. The businesses and the hype around it went way ahead of what it was capable of.
Yeah.
Super over optimistic and then cratered and then became super pessimistic. Whereas it actually took nearly a decade for the real fruits of the internet to actually pay off. This is a life altering technology, it's a world changing technology. It is. But again, I can't even say the people leading the charge are greedy or if only they would just temper their enthusiasm. We could do this in a nice, systematic way. That's not how big infrastructure gets built. It is the hype of the internet that led AT&T and which is the other company,
Telecom.
the telecom companies to actually lay the infrastructure that made the internet possible. Without the hype, they would not have invested the money, right? So for large capital cycles, this is necessary. It's unfortunate and it causes a lot of unexpected, unforeseen consequences, but it is essential
I will
for
push back. I
infrastructure
will.
build.
I will push. I actually see your thesis and I agree with it in some areas. A life altering, sure. This is what feels like what should have been the natural progression of search in one way, right? Like if I'm on Perplexity talking about, okay, look, help me compare this one particular lens to another particular lens.
Mhm.
And first give me 10 parameters you'll compare it on. Don't just give me an opinion. Right. Based on Reddit searches, the specific forums that I go to, or any other forums that can dig up that I might not have access to. Right. And then compare parameters on those 10 rather than me going to some SEO slop. Right. There's the terrible sites like versus.com, which pop up anytime you do any hobby search for A versus B, guitar, lens, whatever. I'm just talking about the ones I know of. It's
Right.
SEO slop
Yeah.
put together by bots, right? Or
Which,
generated
which
on the fly,
predates AI.
which predates AI, absolutely. Right.
Yeah. Yeah.
But what we have built, or what these guys have built is in a way the natural successor of what search should have been. It's fantastic. Uh, and also, this is ideally, it's a window into how to talk to a computer, right? Claude Code,
Yes.
right? Rather than learning a programming language, you talk in natural language back and forth and it programs for you. Fantastic, right? That's huge progress. Fully agreed on that. And I use so much of AI. I'm not uh, skeptic of, I'm not saying there are no use cases. There are fantastic use cases. The hype, yes, absolutely. I won't even go there. I've talked about it enough. The hype is insane. Your thesis is that the hype is necessary to get the necessary investments, right? Otherwise, it just won't happen. No, I will just push back on that. Are these necessary? Right? Because the costs here are like, we're talking in the at least $1 trillion, right?
Hmm.
If not more, 1.5 trillion, whatever, right? A, if the costs are so crazy huge as compared to any other, like your entire railroad systems, or like $1 trillion is so many zeros. What could that $1 trillion of investment do to the world? Right. Let's not even go there. What all $1 trillion of investment could fix in this world when climate change is actually killing us all, right? Or about to kill us all. Let's not even go there. $1 trillion, right? But even from a business perspective, if you think that $1 trillion is necessary, why won't you just automatically think of, okay, can we somehow reduce the compute usage and put a few $100 billion into figuring that out, because this $1 trillion will also increase over time. Compute will grow over time. They haven't been able to find economies of scale, right? These are the actual, like, okay, let's say keep up your hype to get the investment running,
Hmm.
right?
Hmm.
But in the meanwhile, like something like a DeepSeek, right? Whose entire thing, why did it get so hyped up, was because it actually talked about, look, we can run. It's not like, okay, DeepSeek can do the same thing that Claude or ChatGPT can. The entire hype was because here is a model that can do the same thing on your computer, or if not on your computer, on a very powerful computer, but at 2 to 3% of the uh, inference costs, right? And we know they stole their training data. There's enough whatever, but everyone stole their training data, right?
Hmm.
So efficiency was why DeepSeek got hyped. So why are these guys not focusing on efficiency at all? They just, no, let's build more data centers, more data centers, more data centers, more data centers.
They're not.
They're not talking about it. No, I know. We have discussed this point before. If if they actually believed they were getting somewhere on the efficiency argument, let's say they're not talking about it, right? Sure.
Hmm.
Then they would have no reason to keep pledging all this money towards data centers.
No,
It's not just
that's just
press releases.
that's just prudent extending your runway as a founder. It totally makes sense. If you can project that you need to spend so much money, you can raise much money.
But that much money which you need to pump into data centers, why else
And
do they need
if
money? It's all software otherwise, right?
if
Then
your
why do they need money?
if your venture makes that breakthrough or the ecosystem makes a breakthrough, that means that all that capital build out is no longer necessary.
Hmm.
So what? You raise more money than you need. That's not a bad
That's
problem to have.
insane amounts of money wasted then.
No,
Right, again, as a
we
founder,
can
sure,
say
they're doing what they need to do to keep their incentives are very different from.
yeah, exactly.
Yeah, yeah.
They
Again, we can justify anything in the name of capitalism. We can absolutely justify anything in the name of capitalism. But the point is, I don't think the efficiency argument is really playing out, because if they themselves felt that they're getting somewhere, this is real money they're putting into data centers that could be used elsewhere, right? It could pay better salaries, get better researchers. ChatGPT is bleeding AI researchers.
Mhm,
Grok is bleeding AI researchers, right? The people they really need, because they can't pay enough salaries, right? That money could have been used here. These are insane amounts of money that are going into compute build out. And if the argument is that they are working on efficiency, so they'll need like 5% of what they're planning for,
mhm.
then they're already too late. They are already way too late. If they're working on it, they need to put their money where their mouth is. I don't think they're working on it, or they haven't gotten anywhere, because the hype justifies. They get personally richer if they hype up everything. If they plan on, which is exactly what you are talking about. If I say I need to raise $1 trillion, that is a better play for me as a founder than if I say I need to raise $1 million. So that is what is actually going on. It's not that there is some magical efficiency here that is in my head, that they're not talking about, but is actually there.
And if that
They're
happens,
just not incentivized to do it.
great.
If it happens, but these are crazy, huge, long cycles that we're talking about. See, I use hype in one sentence and cycles in the next, not together. They're just moving in in a completely different
I
direction.
don't want to see what you did there.
Yeah, yeah. They are just moving in completely different directions. I don't think there is a core efficiency play, when actually efficiency is everything, because all of this, if nothing else, it's a crazy huge distraction that is taking them away from their own core business, whatever. And my last point here is that the revenues are just not there. How much are you paying for Claude Code? How much are you paying for Gemini Pro? Zero.
Zero. Yeah.
Zero. Right. Let's say if this did, so one thesis of mine is, if this geo thing were not there for free,
Mhm.
you might have still paid $20 a month. Most people who are using Gemini Pro in India would not.
If the Geo thing wasn't there, I probably would never have tried Gemini.
See.
Now that I have, if
Hmm.
the Geo thing goes away tomorrow, I will pay.
हाँ तो ठीक है try before you buy. We know it works for a
Yeah.
certain number of customers, a
Yeah.
certain percentage of customers. Absolutely, it doesn't work for 100%. It'll work for 10%, sure. Right. I am not even arguing into the marketing benefits, the GTM, the go-to-market benefits of these kinds of deals. Right. I am just saying that you might pay $20. It is probably costing Google $60 to $80. Uh, Sure, they can say eventually it will come down. We don't see that yet. It's increasing. They're losing. I don't even know how to say whether it's costing them $60 or $600, because we know even on $200 they're losing money. So the more you use, the more money they lose. They're losing on a per token basis, not just on an aggregate basis, right? Which is just, from no perspective do the economics make sense
Today.
today, but from no perspective do the economics make sense today. And they're not even getting closer. They're getting farther and farther on every perspective that we know of. And the money is just, even the revenues are not there. If the revenues were high and growing like mad, but they're so far completely insanely different that we're talking $1 trillion of spend out. And sure, in theory, $1 trillion of revenue, you can say whatever, but we're sitting at like aggregate revenues of 20 to $30 billion for the industry. That is where this complete thing is just so completely, totally mismatched. They're not even operating on the same plane of existence at all. So, yeah.
One last counterpoint, and I think we can call it there. I'll not speak for OpenAI or Perplexity, but in the case of Meta, in the case of Google, especially, for the most part, I know they have raised some private debt, which brings us nicely back to the topic of our day. But for the most part, this is money that otherwise would have gone for stock buybacks or out as dividend. Isn't it nicer or preferable that they spend it on actual things?
No, absolutely not. I would absolutely push back against that because the data centers, it's not like, so there is a thesis that, oh, if the bubble bursts, these GPUs and data centers can be used for other stuff, right? But no, they're optimized for this stuff. For this stuff, they're absolutely 100% optimized for this. And again, there are bigger problems for the world to solve. You put the money back in your bank. This is not infrastructure that is helping the world right now. They absolutely, and again, while admitting, accepting fully, like I'm a proper user of Claude, right? This is not even me reluctantly or hesitantly saying this. I
Right.
use it a lot. My startup uses it a lot. We are iterating much faster because of this.
Hmm.
I am doing so much stuff faster because of this and better, right? In many ways. Uh, but they need to be working on compute efficiency and bringing it down to 1% as fast as possible. And if they felt that they are getting anywhere close to it, they would not be putting all this money in, taking on so much debt, burning all their free cash flow. Like imagine Meta and Google, the two companies that are the biggest money printers in the world because of their ad platforms, are putting all this money into building out long term compute, spending this money, giving it to companies who have no background. They're blockchain and crypto companies getting into data center build outs,
Grifters.
no background. So, yeah.
All right. Let's leave it there. We'll let
Yeah, let's see.
yeah.
Unless you want to end on a happy note.
I will end on a happy note. I'm going to plug my piece again. I
Yes,
really enjoyed writing it. Please put it in the show notes.
I
I
will.
more people read.
Done. And thank you. Enjoy the rest of your Sunday and enjoy the rest of whatever day you are on when this episode goes live, everyone. I'm one episode behind on editing, but yes, such is life. See you, Nitesh. And see you, everyone. Thank you for tuning into Hype Cycles. Bye bye.